Okay. So the first we will write particular and note number and then the amount. Generally, amount of 2 years are written in balance sheet. Okay, the current year and the previous year. Okay, so if there is 2 years data, then you can write you can create two columns for that. Now, the first side, the upper side, is called equity and liabilities. Equity and liabilities. Under equity and liabilities, the first item is shareholders fund. And we have already discussed the concept of share capital under shareholder fund. Yes?
Yes, sir.
Okay. So do you remember the concept of share capital?
Yes, sir.
Okay. Can you tell me what different kinds of share capital, name of different classification?
Yes, sir. We have authorized capital, issued capital, subscribed capital, called up capital, and paid up capital.
Okay. Can you tell me brief about these?
So, authorized capital is the capital at the time of the registration, and it is the maximum capital for a company.
Very good.
Issued capital is a part of authorized capital, for which the company invites application from the public.
Okay. Very good. Subscribe capital.
Then subscribed, it is a part of issued capital, and it is the number of share for which application is received.
Very good. Okay, so which number of share we generally write in our balance sheet? The subscribed one or issued one? Which number of share is written in balance sheet, or issued shares or subscribed shares?
So issued shares.
No, actually we write lower of these two. If issued is lower than subscribed, then we write issued, and if subscribed is lower than issued, then we take subscribed as our main number of share.
Okay, sir.
Okay, next.
Next is called up capital. It is a part of the subscribed capital, and the shareholders can pay the amount either in lump sum or in installments.
Actually, the company demands money on shares. Okay. Actually, whenever we ask our shareholders to pay us money, we can ask this amount in lump sum or installment. When there is lump sum concept, when we ask money in lump sum, then there is no concept of called up capital. Okay, because all the money is asked at the time of application.
Okay, sir.
But when we ask money in installment, then we can ask some of the amount of shares, and we can leave the balance for some future purpose. Okay, so whatever the amount we ask from our shareholders in installment is called up capital.
Yes, sir.
The next is paid up capital, means when we ask money from our shareholders and how much amount they pay us. So this is called paid up capital. The difference of called up capital and paid up capital is called consignee. Now, the next is reserve and surplus. Okay, so what is reserve and surplus? Can you tell me what is a reserve means?
So reserve means keeping a part of their profit or investment separate for unexpected things.
Okay. Reserve and surplus, you can see there is two words. The first is reserve and the second is surplus. So when we save money for any future purpose, either certain or uncertain, it is called reserve. Okay.
Okay, sir.
So there are different types of reserves. Some are related with certain items and some are related with uh, simply, some are not related with any thing. So these are generally related with uncertain items. Okay.
Yes,
Like when we talk about general reserve, it is not related with any item of the balance sheet, or the objective of this reserve is also not specified. That's why it is called general reserve. So it is for future uncertainties. But when we say workman compensation reserve, when we say investment allowance reserve, these kind of reserves are related with some specific objective. So that's why these are certain. Okay.
yes, sir.
Okay. And can you tell me what is the difference between reserve and provisions? What is provisions?
So provision is anticipating a future loss or expense and keeping aside a provision for that particular thing.
Then how it is different from reserve? Actually, provision is a liability. Okay.
Okay, sir.
And provision is charge against profit, but reserve is appropriation profit. We can save some amount for our future purpose, or if we wish, then we will not save the money. Okay. So reserve is on your you can say wish, that you want to save money, then okay. If you want to you want not to save money, then it's okay. But you have to keep aside the money for provisions, because it is charge against profit. You cannot uh, deny this. Okay.
Yes, sir.
Okay. Now there are different types of reserve. I'm giving you one or two examples of for this. So in reserve and surplus, there is two I name you can see: reserve and surplus. Surplus means the profit. So generally we take balance of statement in profit and loss. Okay. A statement of profit and loss. This is our surplus. It is also called undistributed profit. Okay.
Yes, sir.
And when we say reserves, then we can include general reserve, capital reserve, revaluation reserve, capital redemption reserve. So these are reserves which are included in this. There are some other reserves also. It is not the end of the list. Okay. There are various reserves that we have to study, but generally 2 or 3 items are given. So you have to remember these things. Okay. There is actually, I leave a very common reserve: securities premium reserve. Okay, this is securities premium reserve. So we include these items in our reserve and surplus. Is this clear?
Yes, sir.
Okay. After that, we write the next item here as money received against share warrant. Okay. So what is share warrant? Actually, these are not part of your syllabus, but these are included in balance sheet format. So that's why I'm explaining these so that you will know these things. Do you know what is share warrant?
No, sir.
Okay. So warrant means, uh, warrant, not share warrant, only warrant.
Yes, sir.
Okay. Can you tell me what it is?
Sir, it's like a security provided for a period against damage or like something of any product.
Warrant. Okay. Generally, we see warrant as arrest warrant. So when a court issue this arrest order, then it is called warrant. So in the same manner, if a legal authority or court issue a warrant to the company for giving shares to someone after some days, okay, or in a company itself issue share warrant to someone that you can claim shares after certain time, okay.
Yes, sir.
Okay, so generally it is order given by court or some statutory authorities, okay, to someone to receive share from the company. Then it is called share warrant. So when company receive money for these types of warrant, then it is called money received against share warrant. Okay.
Yes, sir.
Okay. Okay. Do you have your balance sheet format with you?
Yes, sir.
Okay. So it is the third item, money received against share warrant. It is given. Yes.
Yes, sir.
Okay. After that, there is an item share application money pending allotment. Now, with this line, you can understand the item. Okay. So can you tell me what do you understand by that line? Yes. Okay. So I told you that there are different classification of share, and when a company demands money from public, from the shareholders in installment, then there are different installment given, generally four. Okay. So okay, so when a company issue its share in installment, the name of the installment is application, allotment, first call, and final call. These are the installment name. Now, company can receive full money on application itself. A company can demand full money on application and allotment or first call. So company can decide that how many installments will be there. Okay. So in, let's say in an example, there is 4 installment asked by the company. Okay.
Okay, sir.
Okay. Now, the first installment is demanded, means asked, application is invited, and the public has applied for shares. But before allotment, the financial year is complete. It is closed. The accounts are closed. Okay.
Okay, sir.
So the installment date, let me write this. There is 4 installment. The first is on 28th March. The second is on 15th April. The third is on 15th May. And the last one is 15th June. Okay. So on 28th March, company receives application money, and on 31st March, the year is complete. Now the financial year is complete. So we will close our books on this date, on 31st March. Okay. After that, we will allot these shares. Yes or no? In next year.
Yes, sir.
Yes. So that's why it is written share application money received pending allotment.
Okay, sir.
Okay. The next is non-current liabilities. Now, you know the classification of non-current and current liabilities.
Sir, classifications as in
Non-current liabilities and current liabilities. There's 2 types of liabilities. Same with the assets, non-current assets and current assets. So you know how to classify these things, these liabilities and assets. Why it is called non-current and current?
so because of the time period.
Okay, and what is the time period?
So 12 months.
12 months. Yes. So actually, you need to understand that there is a concept of operating cycle also. I think I told you once, but if you remember,
Yes, sir.
12 months or operating cycle. We consider these 2 factors for decision of current and non-current. So whichever is higher. If operating cycle is less than 12 months, then we will take 12 months for this decision. And if operating cycle is more than 12 months, then we will use operating cycle for this type of decision.
Okay, sir.
Okay, so let's say if the operating cycle is 9 months, then current and non-current will be decided on the basis of 12 months. Okay. And if operating cycle is 14 months, then we will not consider 12 months. We will consider 14 months for current and non-current decision. Is this clear?
Yes, sir.
Okay. So non-current liabilities are liabilities which is to be paid after 12 months or after operating cycle. Okay. And in the same manner, current liabilities are liabilities which is to be paid within 12 months. Okay.
Yes, sir.
Now, in operating cycle, in non-current liabilities, there are different items. The first is long-term borrowing. Long-term borrowing. The second is deferred tax liabilities. Deferred tax liabilities. Sorry, deferred tax liabilities. Okay. The next is long-term provisions. And the last one is other non-current liabilities or long-term liabilities. Okay. Now, which are the items that is included in these 4 items? Okay, so first of all, long-term borrowing. Can you tell me 1 or 2 items that will be included in long-term borrowing?
So loan from bank.
Loan from
Bank.
bank. Okay, and sometimes I get confused in deferred that it will be double F or double R. So, okay, so loan from bank. Okay, and okay, so loan from bank can be written only in long-term borrowing, or maybe it is also included in short-term liabilities.
So it can be written in short-term liabilities.
Yes, loan from bank can be of different types. If it is for 8 months, 9 months, then it will be included in short-term borrowing. Okay, but if it is for 2 years, 5 years, 10 years like this, then we will include these loans in long-term borrowing. Actually, in long-term borrowing, there can be different types of loan like term loan, mortgage loan, debentures. Debentures, you know what is debenture?
Yes, sir.
Okay. So debenture is also included in long-term borrowing. Okay. So these type of liability we include in long-term borrowing. This clear?
Yes, sir.
So term loan, mortgage loan, and debenture. There can be different items also. So debentures. And what is deferred tax liabilities? No tax liabilities.
So could you repeat?
You know what is deferred tax liabilities?
No, sir.
Okay. You never seen this word, you never listened this word.
So you're lagging.
Okay. Am I audible now?
Yes, sir.
Okay. So I was can you see the screen?
Yes, sir.
Okay. I'm still lagging.
Yes, sir. You got stuck for a bit again.
Okay. Network strength is showing good, but okay. So non-current liabilities, long-term borrowing, term loan, mortgage loan, and debentures. Now, what is deferred tax liabilities? Actually, there is a similar item in asset side also that is called deferred tax assets. So we will understand these two items together. What is deferred tax assets or liabilities? Okay. There is two acts that is applicable to a company's balance sheet. Okay. So one is Companies Act. And the second is Income Tax Act. You know about these two acts?
I've heard of it.
Okay. You know anything about these two acts?
No, sir, not its functions specifically.
Okay. So there is two acts in India for governing the companies for its financial statements and tax. Okay. So Companies Act, there are certain provisions in Companies Act, there are certain provisions in Income Tax, which are different from each other. Okay. So Companies Act says something else and Income Tax Act is different. Okay. Like depreciation. Companies Act tell us to charge depreciation on SLM method. However, Income Tax Acts tell us to charge depreciation on WDV method. Okay. And the rate is also specified in Companies Act. Same rate is specified in Income Tax Act also. Okay. So like this, there are different provisions which are not similar in these two acts. Okay. Due to that, sometime in Companies Act, tax payable is less. Tax payable is less than tax payable in Income Tax Act. Okay.
Yes, sir.
And in some of the case, tax payable in Companies Act is higher than tax payable in Income Tax Act. Okay. Now, can you tell me that tax will be paid to government on the basis of which act? Companies Act or Income Tax Act?
Income Tax Act.
Yes, because it is specifically for tax purpose. That's why company pay tax on the basis of Income Tax Act provision. So here in first case, you will pay higher tax. Yes or no?
Yes, sir.
And in second case, you will pay lower tax than Companies Act. Okay.
Yes, sir.
But in the beginning, this is applicable. This higher tax will be applicable only in the beginning, and this lower tax will be applicable only in the beginning. Now, you have to understand this by example I'm writing here. Let's say if the assets, there is an asset value of 1 lakh, okay? And 25% depreciation is charged on the basis SLM basis in Companies Act, and 50% depreciation is charged in WDV method. Okay.
Okay, sir.
Okay. So in first year, the depreciation will be charged 25,000, 25,000, 25,000, and 25,000. In 4 year, the depreciation is this. Yes.
Yes, sir.
And if we go to Income Tax Act, the first year depreciation will be 50,000. Yes. Second year depreciation will be 25,000. Third year depreciation will be 12,500, and fourth year depreciation will be 6,250. Yes or no?
Yes, sir.
Okay. Now, if you see, we are charging depreciation higher in Income Tax Act in the beginning only, but after that, the depreciation is lower than the Companies Act. Yes.
Yes, sir.
Because total assets value is 1 lakh and we have to depreciate this amount in many years. Okay, so if you finish the asset in 4 years, then the depreciation is same in all the year, and if you charge depreciation higher in the beginning, then it will be lower in the last. Or let's say, let's take this example, not this. Let's take SLM method in both of the example. Let's say in second year, it is also 50,000. Okay.
So how?
Not WDV, SLM.
Okay, sir.
Okay. I'm just taking different tax rate. So 25% SLM in Companies Act and 50% SLM in Income Tax Act. So in first year, depreciation is higher in Income Tax Act here. In second year, depreciation is higher in Income Tax Act. But in third year and fourth year, the depreciation is lower than Companies Act. Yes or no?
Yes, sir.
Okay. So if you save tax in first and second year, then you will be charged more tax in third and fourth year. Yes or no?
Yes, sir.
So it happens here that tax payable in the beginning is higher. If it is higher, and it will become lower in future years. Just wait for a minute. Okay. So if the tax payable is higher in the beginning, then tax payable will be lower in the last. Yes.
Yes, sir.
Okay. So if you are paying higher tax, let's say you are paying in the beginning, you are paying 15,000, and then you in the last you have to pay less tax, that is 5,000. Okay. And if you are paying 5,000 in the beginning, then you will pay 15,000 in the last. Yes.
Yes, sir.
So due to this difference, a tax liability or asset is incurred. Let's say here, if we pay, if we save 30% tax, if we save 15,000 tax here, not 15,000 because 25,000 in Companies Act also. So the difference is, how much difference is? 25,000 in first year, 25,000 in second year. Yes.
Yes, sir.
So we are paying less tax of 7,500, less tax. 7,500 less here. But in the third year, you will pay 7,500 more and 7,500 more than Companies Act. Okay. 30% tax rate. So 25,000 and 25,000. So in first 2 year, you are saving 25,000, but in the last 2 year, you have to pay more tax. Okay.
Yes, sir.
Okay. So that's why if you are saving 7,500 in first year, then you have to pay 7,500 in third year. So it is generally set off. Okay. It is generally set off. Is this clear?
Yes, sir.
So due to this difference, if we are paying 7,500 here, then we know that this 7,500, which we are paying less in current year, we have to pay it in future. Yes or no?
Yes, sir.
And if we are paying 7,500 higher in current year, then we will save 7,500 in future years. So if you are paying higher, then it is assets for you, because you will save 7,500 in future. Okay.
Yes, sir.
And if you are paying 7,500 lower in current year, then you will pay 7,500 higher in future year, and this is your liability.
Yes, sir. Got it.
So that's why it is called deferred tax liabilities and deferred tax assets. So if you have to pay in future, then it is liability for you, and if you will save in future, then it is assets for you, deferred tax assets and liabilities. Okay.
Okay, sir.
Next term is long-term provisions. Now, as we discussed the provision here, can you tell me one or two example of long-term provisions that we need to pay after 2 or 3 years?
So I only know provision for bad debts, but I don't think that's a long-term provision.
Okay, provision for bad debts.
Yes, sir.
Provision for doubtful debts, you are saying.
Oh, yes, sir.
Yes. Actually, we don't provide for bad debts. Bad debts is already bad. That's why we don't have to make provision for it.
Yes, sir.
Okay, so provision is a current liability. You can see a provision is a present obligation, or you can say present liability. Okay, present obligation, the amount of which is not certain, and we can only measure the amount on the basis of certain estimates. Okay.
Yes, sir.
Okay. So generally provision sometimes related with assets also, like provision for depreciation, provision for bad and doubtful debts. So we write these provisions which is related to assets. But here we take actually the provision for bad and doubtful debts and provision for depreciation is deducted from respective assets. That's why we don't include those provisions here. Okay. So provision of bad debts will not be included here.
Okay, sir.
Okay. Now, provision related with retirement benefits of partners. When employee retires from our company, then we have to pay certain amount to them as a retirement benefit. Okay.
Okay, sir.
So retirement benefit is generally long-term in nature because it will be generally paid after 60 years of that employee. Okay, so if he works 20 years in the company, then it will be payable after 20 years. Yes, so it is long-term.
Okay, sir.
Okay, sometime there are different kind of provisions, like you can say provision for tax is actually short-term provision. Okay, provision for tax because you have to pay tax every year. So in current year, if you are providing for tax, then you have to pay within 12 months. Yes, so it is short-term provision. Okay.
Okay, sir.
So in provision related to retirement benefits, there is provision for pension, provision for superannuation fund, or you can say provision for gratuity. These different types of retirement benefit given. So we create provision for these types of liabilities. Now, other long-term liabilities. Now, after term loan, mortgage loan, and debentures, there are certain liabilities which is long-term in nature, but it is not included in long-term borrowings. Okay.
Yes, sir.
Okay. Do you know what is meaning of borrowing?
Yes, sir.
Can you tell me?
So borrowing is like getting something from somebody else.
Okay.
And we,
Yes. So in long-term borrowing, we include only those types of loans which is taken by company from a bank or financial institution or any other place. But there are some other liabilities which are liabilities, but we have not borrowed these funds. Okay, we have not borrowed. They have given this amount to us. Okay.
okay, sir.
Like generally when we let out our property, we give our property on rent, then we receive certain amount of deposit. Yes or no?
Yes, sir.
So this is not borrowing. This is a deposit money. Okay.
Yes, sir.
But it is a liability. Yes or no?
So how is that liability?
Okay. So you have a property, okay, and you want to give it on rent. You have a building and you want to give it on rent. So they will pay you some advance money. You can say advance rent or advance deposit. Okay, they will pay you that at the time of leaving the building, then you will return this money. Yes.
Yes, sir.
So this is liability.
Okay, sir. Yes.
Okay, but it is not your borrowing. You have not taken this money for your business purpose. Yes, they have given you for security purpose.
Yes, sir.
So these type of liabilities are not included in long-term borrowing, but these are liabilities. And if these are long-term in nature, then we will include these in other long-term liabilities. Is this clear?
Yes, sir.
Okay. Now, long-term provisions we understood. After that, we have current liabilities. And in current liabilities, there is first item is short-term borrowing. Now, these are also loan, but these are short-term in nature. Can you tell me one example of short-term borrowing?
So call money.
Call money. Okay, we can include cash credit, bank overdraft here also.
Yes, sir.
These are the short-term borrowing actually. Okay, you can also take call money means calls in advance, you are saying?
Sorry, sir, what?
Calls in advance, you are saying?
Yes, sir.
Actually, calls in advance will go to other current liabilities.
Oh, yes, sir. Yeah.
Okay, and also in long-term liabilities, we also include trade payable sometime. Trade payable, which is payable after 12 months. So these are also other long-term liabilities because these are not borrowed funds. We have purchased goods on credit basis and it is for long-term purpose. That's why it is also included in other long-term liabilities. Okay.
Okay, sir.
Okay. So short-term borrowing, cash credit, bank overdraft. So the fund which you borrow for short-term purpose is included short-term. After that, there is trade payable. Now, in past, there is no classification of trade payable. Okay. There is no classification given in balance sheet, but now it is categorized in two parts. And the first one is amount payable to micro and small enterprises, and the second is non-micro and small enterprises. Yes.
Okay, sir.
Actually, government wants to promote the micro and small businesses. Okay, that's why they think that if a company will show its classification, then they will generally pay these amount to the small business, because if you keep small business money, then they will be finished. There is no hope for those companies. They are small businesses, they cannot suffer these type of losses. Okay.
Yes, sir.
So that's why government now classified these trade payables into two categories, that you will have to show the liabilities which is payable to micro and small enterprises. So you should pay those liabilities on time.
Okay, sir.
Okay. So trade payable is now classified. In trade payable, we include creditors and bills payable. So these two items. Now the third is short-term provisions. Like long-term provisions, these are short-term provisions. I will give you the detailed items of detailed items that is included in short-term and long-term provisions. Okay, I will show it to you in our next class. In fourth, there is other current liabilities. So these classification are similar in nature. Short-term provision and long-term provisions are same, but only factor that differ these two is time. Okay, so provision which is created for long-term purposes, long-term provision and the short-term provision. Okay, so if the retirement benefit is payable within 12 months, let's say some employees are retiring within a year, then it is called short-term provisions. But in the same manner, if employees is retiring after 5 or 10 years, then we will call it long-term provisions. And I also told you provision for tax. This is for short-term provisions. Okay.
Yes, sir.
So these are our liability side. Now, do you have any doubt in any of the liability side topic or item?
So what comes in trade payable?
Trade
Creditors and
payable, bills payable,
okay, sir.
creditors and bills payable. Okay.
Yes, sir.
Okay, so now you can solve some of the question from the book. I will share it with our team and they will give you the assignment. Okay.